Are you thinking of investing in stock markets? Because if you invested rupees 10,000 every month from 1999 onwards, then you would have 2.55 crores by now. Or if you invested a lump sum of 1 lakh rupees, then you would have more than 26 lakhs by now. That would mean a compounded annual growth rate of about 14.5%, which is way more than the average returns you could have made in the good old FD or gold. Now this might sound like sab grow kar rahe hain, right? However,
that don't make a lick of sense. That don't make a lick of sense.
Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%. The stock market is now down 21%.
We're now down 43%.
What in the world is happening on Wall Street?
2-year note yields went from 190 to 166 in the blink of an eye.
The NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
Now my wife's gonna leave me. They're gonna repossess my car.
you could have also lost a lot of money. In stock markets, you can find stories of people who have become billionaires just through investing. But you can also find stories of people who have gone bankrupt, committed suicide, or gone to jail. And then there are many people in between these two extremes who have either lost their money, made no money, or have been able to use their savings to achieve their financial goals, like buying a house, buying a car, or spending on the wedding of their kids. Now, how can you try to avoid being on the wrong side of this spectrum? In this video, I'll take you through my journey of how I started equity investing when I was 18 years old and give you 5 tips from that journey. Plus, I'm going to answer a very important question at the end of this video. Should you even invest in stocks? My name is C. Apoorv Singhal. I'm a qualified chartered accountant and I have cleared level 1 and level 2 of CFA exams. And yes, I have been profitable in my investing journey so far. Just a quick disclaimer, I'm not an investment advisor. I'm just sharing my investing experience. Please read the disclaimer before going forward. Number 1, educate yourself. I took commerce with maths in 2014 when I entered class 11th, and I finally started to understand what that ticker tape on CNBC meant. As I got more and more interested about stocks, I got to know about people like Warren Buffett and Rakesh Jhunjhunwala, people who became billionaires just through investing, and about my father's investing success. I was hooked. Luckily for me, I was a commerce student, so whatever I was studying in school helped me build my basics about accounts, business studies, and economics. By the time I finished school and started investing, I already had my basics clear. If you don't even have your basics clear, like what is face value, book value, P ratio, PB ratio, how to read balance sheet, P&L and cash flow statements, knowledge of basic ratios, etc., then I would suggest you stay away from equities till you get your basics clear and can analyze a stock on your own. Number 2, observe before jumping in. It's not like I got to know about the markets one day and I started investing immediately the next day. For 2 years, till I gave my 12th boards exam, I tracked the stocks which my dad and my sister had in their portfolio and tried to analyze them based on whatever knowledge I had. Now, I am not suggesting you wait for 2 years before you invest, but it would be better if you observe the market and a few stocks for a while and learn a little bit before you put your money in them. Number 3, start small. When I started investing, I started with a few thousand rupees given by my father. Later, I started investing the stipend I earned in my CA final articleship and then my salary as a CA. Starting small was important for 2 reasons. 1, you're going to make mistakes, no matter how smart, knowledgeable or gifted you are. We all do. So it is better to make mistakes with smaller amounts. Whatever money you lose in your learning years, treat it as a fees paid for learning a new concept. The key word here being learning. And second reason for starting small is that it is not going to be easy on your heart to look at some of your stocks or your entire portfolio in red. Trust me. And if you invest more than you can afford to lose, then you're going to be in deep trouble if you incur a heavy loss. And chances are that you will.
Stop screaming! Stop!
Experience is required in order to control your emotions while investing. Number 4, take help. See, this is a tricky point and I'll tell you why. For the first few years, I used to confirm my buying and selling decisions with my father. I invested only under his guidance. Also, it was his money that I was investing initially. Now, there are a few things that I need to point out here. One, my father is a CA and he had more than 20 years of experience in equity investing by the time I started investing. Plus, he has been very successful and he would always want the best for me. So, my mentor was a highly educated, experienced, and a trusted person. Many people claim to know a lot about investing, but they actually don't. Many people claim that they are profitable when in fact they are incurring heavy losses. And even the ones who are profitable are not necessarily beating the market. Even experts underperform the market on an average. For every multi-bagger that a relative brags to you about, there are many other stocks in which he has burnt his hands, which he won't be sharing with you. Second, I did my own analysis before buying and selling. I wasn't blindly following my father's advice. I was just verifying my buying and selling decisions with him. That resulted in me having a bit more confidence in the decisions that I made, and also at times he prevented me from making costly mistakes. If you think you are investing based on stock tips from your relatives without doing thorough analysis, then you are not an investor. You don't know what you're doing and you're just a gambler. Fifth, learn from the greats. I believe this point made the biggest impact on my investing. As soon as I finished school, my sister gave me a copy of The Intelligent Investor, written by the Dean of Wall Street, Benjamin Graham, and David Dodd, gurus of Warren Buffett, John Templeton, and many others. This book is a Bible for value investing. Later on, I also studied Common Stocks and Uncommon Profits by Philip Fisher, the first book written about growth investing, and recommended by both Warren Buffett and Benjamin Graham, and One Up on the Wall Street by Peter Lynch, the best mutual fund manager of all time. And I continue to read many more books by legendary investors till date. I've also seen a countless number of YouTube videos of Rakesh Jhunjhunwala and many other greats, and I read articles written by Mr. Dhirendra Kumar and E.T. Wealth and memos by Howard Marks whenever I get time. When there are people who have aced this game and have passed on that knowledge, it makes no sense not to take the benefit of that. I've given a link in the description to buy my top recommendations, and if you want to get an audiobook for free, there's a link to Audibles as well, where you can get 1 month of subscription for free, and you get one audiobook free with it. Okay, all this information is great, but one question still remains unanswered. Should you even invest in stock markets? If your answer to any one of the following questions is no, then please seriously reconsider your decision to get into equity investing. 1. Are you willing to educate yourself? If you don't understand the rules of a game, then you've lost the game before it even started. 2. Do you have willingness to take risks? Can you handle your portfolio built from your hard-earned money being down 20 to 30%? Because when the market corrects or crashes, that can happen to even legendary investors. 3rd, do you have the ability to take risks? Do you have surplus funds without obligations like loan repayment or other big commitments? And 4th, do you have patience? There is no get-rich-quick formula, but you can definitely get poor quickly by being reckless in the markets. If you don't want to educate yourself but still want higher returns offered by equity investing, then I would suggest you go for mutual funds, index ETFs, or portfolio management services. But even in that case, I would urge you to improve your financial literacy continuously. And if you don't have any willingness to take risks and you cannot see your portfolio down by 30%, or you don't have any patience and are looking to get rich quickly, then I would suggest you stick to gold, FDs, or other safer options. I opened my trading account with my father's broker back in 2016, but now I mainly use my HDFC Securities account because I have a bank account in HDFC Bank. In case you decide that you do want to invest in equities and you're looking to open an account, then I've given a link in the description to HDFC Securities. In addition to that, I've also given the link to Zerodha and Grow, the top 2 discount brokerages in India. I haven't used these apps yet because I find my HDFC Securities account to be much more convenient. However, I am thinking of trying Zerodha because it has 0% brokerage on equity deliveries. Grow might be the best app for you if you are a total beginner because its UI UX is the easiest one to use. Okay, update. I have started using Zerodha and I think it is great. I haven't yet used Grow because my KYC is still pending. But yes, the UI UX of Grow is also very great. Also, regarding those account opening links in the description, only Zerodha's link is my referral link. The other 2 links are general links as on the date of recording this video. I request you to do your own research about which app suits you the best. I'm just giving you my referral links so that in case you decide to go with any of these 3, I might earn a referral income which will not come out of your pocket. If I provided some value to you, then please hit the like button, and if you want more such content, then hit subscribe. Thanks for watching and I'll see you in the next video.